What's going on, traders? Sandro O'Connell here with Pristine Capital, coming at you with yet another market recap video. It's March 7th, 2022. I was away from the office for about a week, took a vacation with my girlfriend to Italy. And I tend to do that. I try to schedule my vacations for some of the worst seasonal periods of the year. But now I am back in the office, first day back. Look at this price action that greets me on my first day back. I think I brought a bear market back with me from Italy. Let's take a look. We're going to dive into this price action. We'll take a look at my trades for the day. Before we do that, quick risk disclaimer, nothing in the video should be construed as investment advice or recommendations. Please follow your own trading plan, your own risk parameters. Last but certainly not least, do not YOLO your entire account to any one of my trades. All right, let's dive in. Price action in the indices was an absolute bloodbath. We had the S&P 500 finish down 2.91%, NASDAQ QQQ down 3.69%. Mind you, these indices are actually adding to their losses after hours. We'll flip to that in a moment. IWM small caps are down 2.44%, Dow Jones down 2.37%, and the ARK Innovation ETF finished down 3.62%. Volatility increased significantly in all of these indices. You can see the VIX was up over 12%, and we had negative breadth, pretty much washout breadth across the board. Noteworthy, though, that the small caps actually performed the best out of this group. So there were certain points, especially in the beginning of the day, when the small caps were trying to remain positive, and that was sort of like a silver lining, but eventually really just everything broke to the downside. The beginning of the session, Apple and Tesla were both trying to cling to the zero bound and basically stay positive, and both of those eventually fell to the wayside as well. You'll see there's really no safe havens in this market except for energy. I actually shorted energy today, and that was really my only trade for the session. You can see oil finished up, and we had utilities also finish positive. But really the main dynamic that we're experiencing in the market is we have this Russia and Ukraine conflict that is going on. We already had a bunch of inflation concerns in the market. Remember, inflation was becoming a problem, oil prices were rising, and that caused the Fed to tilt to a more hawkish stance. That was before we had this conflict in Russia and Ukraine, which is really just another shock to that oil market. So you'll see here for our sector map, gold miners finished positive. We had energy finishing positive, clean energy, the solar energy, finishing up positive as well, ticker symbol TAN, and utilities XLU finishing up as well. Everything else got completely smoked. And you'll see some of these areas that were beloved throughout the entire bull market really just got taken to the woodshed. We had home builders down 5.36%, regional banks down big, retail down big, semiconductors down 5.02%. So yeah, really just a bloodbath, and it really just looks like there's a lot of de-risking going on in the market. Style factors completely red across the board as well. Look at this, the high beta style factor was down 5.14%, and the momentum and growth were also down close to 4%. And so yeah, there's really just no bids out there in the market. This is our seasonality, and you can see this really is like pretty much the seasonal bottom of the market, but who knows if we'll actually get like this seasonal rally. But it is noteworthy. While the sentiment is very negative, it seems like the market is just going to flush into the abyss. The sentiment, or not the sentiment, the seasonality does really improve as you approach the end of March. But yeah, today, let's take a look at these indices. There really just were no bids out there in the market. With all of these headwinds, we have, as we just talked about, Russia and Ukraine, we have this oil shock. Take a look at what crude did today. Let's see our crude futures. These hit a high of $130 a barrel for crude oil, 130.5. And then we ended up putting in a red candle and closing up only 3.51%. So does this look like a topping candle? Yeah, it certainly does. And we've had our parabolic rise in crude oil. But the reason for the increase, it's definitely a very legitimate reason where we could have a major supply shock on our hands. So still got to respect it. It's not like it has to start declining here. There's some big geopolitical tailwinds behind the asset. But yeah, it really just seems like at this particular juncture, if you're thinking of reasons to be long the market, there's really not that many. And when you're thinking of reasons to get out of the market, they are plentiful. Like pretty much the news cycle over the past month or so, it's been entirely negative. There are no positive headlines coming out. I mean, this rally over here in the S&P 500, this was sparked by news that Russia was invading Ukraine. And there was like a little rally off of that. But yeah, there's just no good news coming out. The Fed's QE program, I don't really see many people talking about this, but it's actually ending on March 11th. So March 11th, that's in 4 days. You can see the Federal Reserve was pumping in $80 billion a month into the Treasury market all the way up until November. And then beginning in November, this is where they had their like, oh my gosh, inflation might not be transitory moment. And very swiftly, they moved from 80 to 70 to 60 to 40 to 20. And now they're going to be at 0 net asset purchases on March 11th. So this really just shows how sloppy the Fed was during this whole process. You know, they could have been unwinding this program really since the beginning of 2021 when everyone was talking about like the booming economy and like the reflation trade and all this stuff. And I believe what happened was our officials really thought that we could get away with doing MMT and just continuing to print money and it really doesn't matter. So they were just trying to continue to do that and really just like juice the markets. Everybody was loving it, making a ton of money. And they had to abruptly shift their stance. And I think that's why we're seeing some of these issues. But yeah, beginning next week, this is where the market is going to have to fly on its own without quantitative easing anymore. And from what we're seeing right now on the S&P 500, this is not really confidence inspiring. We hit our peak up here at around 4,800. And now here we are, we're at 4187. This is a very significant level on the weekly chart. Take a look. So on the weekly chart, this is our yearly value area. So this shows you, hey, here's where the majority of transactions occurred throughout the year 2021. 4186.25, that is our yearly point of control. So what that means is that this specific level that we are pretty much trading at right now we're at 4188, this is the most traded price of 2021. So what that means is there's a ton of players that are transacted at this exact level. And if we start trading below it, that means that the majority of market participants that bought stocks in 2021 are now underwater. So in just a few short months, we've essentially erased, almost a year's worth of progress in the indices. We're not there yet. And this would be the perfect level for some buyers to step in and defend the market. So beginning tomorrow, we're going to have to see if that occurs. Do buyers step in and go, hey, let's push off this point of control? Or do we slip into the abyss and actually get a test of this yearly value area low at 4055.25? So that's really like the $1 million question at this point. But I think at some point, we're going to need some reasons for these institutions to get back into the market, because when the market looks like this basically means, like, I'm sure there were institutions that were exiting their positions really beginning in November. And let's take a look. November was up here. What does that correspond with? Yup, look at this. November 12th was when the 80 billion per month ended, and when it shifted to 70 billion and really so on and so forth. So yeah, the market, for anyone that doesn't think the market is moving based off the quantitative easing that's going on, the market basically topped right as the QE program topped. So yeah, we're not going to have that tailwind behind us. We're going to need something real, unless we just want to keep getting these like little baby bounces. So that's really the problem the market faces at the moment. Yeah, we're definitely oversold. This was an insane day. But yeah, if there's like headlines of like World War III, inflation, recession, no more QE, like that's just not really a good environment. NASDAQ, yeah, now we're trading down in the after hours. We're cumulatively down 4.07%. And we do have a VPOC down here at around 12,857 for the NASDAQ. Russell 2000 ended up finishing up below this monthly value area low. And yeah, nice big juicy red candle here as well. And then the Dow Jones finished down 2.58%. Very similar pattern. Trading down, not quite at the lows from February 24th, but getting there. And there's this narrative that's like, oh, it's all orderly selling that's going on. And I think there's some point to that. But I mean, the VIX is at 36. So like, for everyone saying like, oh, no one has even panicked in this market yet. Like when the VIX is at 36, that's very elevated. That's not like, oh, everyone's complacent right now. That's very significant. And I think maybe we're just starting to get numb to these like down 3% days in the market and really just this extreme volatility. Let's take a look here. One thing I did notice that looked complacent though was, check this out. Our put to call ratio, this is the intraday figures. When the market's getting panicked, this usually goes to about a 1. And throughout the entire session, this intraday put to call ratio never got to 1. So that was definitely pretty surprising to me, because I've seen it go above a 1 for a lot less. So it's making me wonder, like, if everyone's just getting like put fatigue and they're like, oh, well, the market's not really going to go down, like, you know, whatever, let's not really buy these puts anymore. So yeah, some very interesting dynamics, and we're just going to have to see. Right now in this market environment, I don't think there's a whole lot to do as an active trader, so long as your risk is under control and you're holding on to a cash balance. You know, I'm sure there's some good day trading opportunities, but other than that, you know, I think it's more of like a waiting game, because if the market's not really giving you any reasons to take incremental positions, you know, there's no reason to like go out and force the issue. The one position I did take today was I got long some XLE May 20th 76 strike puts. So this XLE ETF, this one has pretty much had its parabolic move. You can see we took out this VPOC today up around $77. Now I know there's a lot of people are saying like this is the perfect time to get long energy, and I don't really think that's the case. I think especially if there's like some sort of like oil embargo, I think that would be the perfect opportunity to actually get short. And this short position is not saying like, oh, oil has to go down, but I think given the path that it's on, you know, crude is already at $130 a barrel. It's a pretty sizable increase, and especially over the last like 5 or so days, you know, it's a pretty fast move away from this 20-day moving average. So it's not like there's any reason to think that oil is gonna like crash, or this is like the top in oil. But I do think this has just been like a pretty crazy 5 days, so I'm willing to go ahead and take a shot at those put options. Let's take a quick look at our options order flow here. Let's see what we got. Oh yeah, another thing that I just want to point out before we go into that is take a look at the CNN Fear and Greed Index. This thing is at a 13. So really, before I left for vacation, throughout this entire negative sequence we've had throughout the first couple months of the year, we haven't been in extreme fear territory, and now we are firmly in extreme fear. So yeah, the market is definitely in a panicked state. All right, let's flip over to our options matrix and let's just see under the hood what we got here. Let's look at our Tradescape. And we can see for SPY pretty much a ton of puts going up. March puts, March 14th, a lot of very short-term stuff. March 9th, March 7th. So yeah, everyone is like getting those like weekly puts. And let's see, we have Qs, very similar deal, a lot of put activity. Tesla, we are seeing a mixture, and I'm sure it has something to do with like the push to clean energy. Apple, mixture of puts and calls. Gold, wow, all gold calls. Look at this GLD, 235 strike for June 30th. Let's take a look at the chart here for GLD, and then we'll break for the day. Wow, look at that. Yeah, up at 186.41. So gold as well. This is making a parabolic run to the upside. And yeah, gold, it might be in an amazing trend right now, which is looking great. Yeah, this is not really a spot where I'd be like, oh, let me go out and buy gold. But you can see on the weekly chart, this thing is definitely nearing a breakout. So yeah, we've had just like this extreme in a lot of these haven assets because it's been relentless bad news. It's just like bad headlines, bad headlines, bad headlines. You know, so it is a very challenging environment, and one that definitely warrants holding on to a cash balance and really just being patient. There will be better days ahead in the market. So on days like this, it's really just important to maintain your composure. And again, if there's not really much to do, there's nothing wrong with walking away from the desk. If the market is really just like plummeting into the abyss and you have no trades to make and no risk to manage. With that being said, it is good to be back with you all, and I will see you all for tomorrow's video.